I'm excited for all of you to be joining us today. First, let me introduce myself. My name is Uri Greenbaum, and I am the CEO of TipRanks. And I wanted to share a few words with you before the event. Today marks our first live Analyst Award event, and we are amazed to see there were more than 3,500 people who registered. After years of giving these awards to US analysts, we now include UK-based and Canadian analysts as well. Over a decade ago, I came up with a concept of a financial accountability engine that tracks the performance of experts giving financial advice. The idea was to help both institutional and retail investors to evaluate the advice they are consuming. Now with a team of more than 100 employees and more than 3 million monthly users, we are rewarding the top analysts of the year from around the world that our site tracks. Time and dedication have brought us all to this moment, and monumental it is. Before we get started, I would like to express my gratitude to all those that helped us bring this event together to become a success. Our amazing hosts, Joe and Julie, our organizers, Rose, Marina, Varda, and the entire marketing team. We couldn't have done this without you. I also wanted to say that it is a real privilege to have with us today the top analysts. I look forward to hearing their insights, but also to share the appreciation for their dedication, and of course, our appreciation to our TipRanks users who join us and motivate us every day. Now, I would like to hand this over to our hosts, Joe and Julie.
Great. Thank you so much, Uri. Really appreciate the introduction and the little history about our great company, TipRanks. So welcome, everybody. Thank you so much for coming. Welcome to the TipRanks Top Analysts of 2021 live awards. My name is Joe, and I'm the head of enterprise sales at TipRanks.
And my name is Julie, and I am the head of TipRanks TV. We're so grateful to have everyone here with us today. We have the amazing opportunity to host some of the smartest minds on Wall Street with our TipRanks Top Analysts from 2021 from the US, UK, and Canada. So we have the unique and exciting opportunity to hear directly from the analysts themselves today.
A little bit of housekeeping just before we get to the main event. I'm sure that there's going to be some very, very interesting questions out in the audience today. If you guys can type in your questions into the comment field wherever you are viewing us from, we've got a team of people that are going to look through the questions. We've dedicated a little bit of time at the end for Q&A and would very much like to get to your questions. We're certainly going to give it our best. One other thing that's really important for us to emphasize is TipRanks does not give financial advice. We help investors make smarter, data-driven decisions when finding their investments, but we do not give out investment advice ourselves.
All right, without further ado, let's get started. We're going to bring in the analysts that we have with us here today.
Great. So we're so excited to have these four absolute top performing analysts with us today live. These guys are literally the cream of the crop when it comes to the performance analysts in 2021. They come from three major geographic areas, from the US, from Canada, and from the UK.
So congratulations to all of you guys for your success this past year. To start, we want to quickly highlight all of your successes. And just to note, we did have Randy here with us as well. I think he's having some technical difficulties. So our fourth analyst should hopefully be joining again here soon. But to start off, we're going to start with my home country of Canada. Representing there, we have Jeremy McCrae from Raymond James. He focuses on the energy sector and has had an amazing 81% success rate with a 20.6% average return per recommendation over a 3-month period with 59 different ratings. So great job, Jeremy. Jumping over to the US, like I said, Randy was with us earlier, but we'll still highlight him here. Randy Givens from Jefferies, focusing on the services sector. He has a fantastic 76% success rate with a 22.7% average return per recommendation over a 3-month period with 58 ratings. So great job, Randy. Now, Joe, I'll hand it to you.
Thanks, Julie. So we have John Gerds from MKM Partners. As you can see, his average return on his recommendations has been a mighty 24.9%. And his success rate Wow, 93%. John, you're definitely doing something right. We're so pleased to have you here this evening.
Happy to be with you.
From the UK, we have Portia Patel. Portia is at Canaccord Genuity. Her average return per rating is 12.32%, and her success rating is 72.3% when measured against 3 months and based on the 33 ratings that she's made. Now we're going to go ahead and ask each one of you a few questions. We're going to put you on the spot, so to speak. There are general questions and there are some specific questions. So over to you, Julie, to kick it off.
All right, we're going to start off picking on Jeremy here, if you don't mind. So high level here, when you're going to look at a new stock or new company, what is kind of the outline or process when you're looking to make a new recommendation?
Yeah, I would say too often than not, when we talk to investors, they focus all on the same thing. It's all the same things that we've learned from, the CFA or the university, and it's all the questions on, what's this growing at, what's the free cash flow, what's a balance sheet, what's a valuation. It's all the same metrics, and there's no real edge if we all just kind of keep on focusing on those same metrics here. And so what is really specific about the energy market is trying to understand, this is what everyone looks at, but where can you find holes in those patterns? And so one of the things that we always try and do is it's not so much in the energy market what the underlying cash flow is doing, like the commodity will do what the commodity does, but to find the best performing stocks, we find that in any kind of year, going back 20 years here, the best performing names were the ones that had the biggest multiple expansion. And to get those biggest multiple expansions here in the energy patch, you need to understand if the company is finding a new play, new exploration, new way of doing things. And having to be in Canada here in Calgary in the middle of the energy sector, you talk to a lot of engineers and nuances, and you can kind of get where the inside is of what's working and what's not, and what company is going to be onto the new play. And then that's where you can kind of change your recommendations in terms of, this is the company that should see the biggest multiple expansion because of a new play that's occurring in their property here.
Awesome. Looking for that edge. Another question for you. With recent inflation data being on the high side and inflation being a big buzzword lately, what stocks or sectors would you see as a good hedge?
Historically, energy has always been, very well correlated to inflation, and you could, correlate it, or a cause of inflation is always up for debate. But in the eyes of investors, though, they see energy and inflation going hand in hand together, and that's typically why we're seeing more inbound phone calls than I've really kind of ever seen here, at the start of the year. So it's energy is doing well, and we're seeing more investors come into energy because of that inflation worry.
Awesome. Thank you. Now, it looked like we had Randy back for a second, but I don't know if he's fully back in yet. So I might pass it over to you, Joe, then for some questions, and we'll see if Randy gets back here in time as well.
Okay, so this one's to you, Portia, please. If you were to pick on 2 socio-demographic or geopolitical risks that might come up during the course of 22, what would they be and why?
Very good question. And maybe I'll touch on one of each. So inflation's just been mentioned, and I think that feeds into one of the key socio-demographic risks that we're all talking about, especially here in the UK, which is rising real cost of living and a potential crisis in that regard. So we had the latest inflation data out here in the UK from December, which showed the highest rate of inflation in 30 years. And it's pretty broad-based. It's energy bills, it's food, it's clothes, it's housing costs. So real risks here. And I think remains to be seen whether wage inflation, which we are seeing some of, keeps pace with that. But if it can't, then, clearly we may have a real cost of living crisis. So it's an interesting risk for me with respect to some of the banks and lenders that I cover. So Provident Financial is one example. It's a £900 million market cap company, and its main business is credit card lending to near prime customers. So rising real cost of living on the one hand could be good for demand, higher demand for credit, but on the other hand, potentially causes rising bad debts. So it's a double-edged sword.
Right.
I think a real kind of interesting socio-demographic risk that's really, really hot and in focus at the moment. I think geopolitical, I think there are probably a few one could pick. I mean, transition to normal from the COVID scenario is one, and I think that will continue to be a theme throughout the course of this year. You know, how nations are transitioning from their COVID states to a back to normal. China, for example, has gone for its zero COVID policy, and that's caused issues because they've had to close down whole regions and whole kind of therefore sectors of the economy just for a handful of cases. So that has an impact on global supply chains and continues to push supply side inflation. So, you know, that I think is a key risk affecting a number of different sectors. Also probably worth mentioning Russia and it's the situation in Ukraine and the potential, going back to the energy markets, you know, the potential what sanctions could cause in terms of Russia disrupting European energy supply. Again, another supply side inflation catalyst. So I think all of those feed into, you know, risk, overall market risk sentiment, the kind of risk off that we're feeling at the moment, which again is interesting for positioning with respect to my coverage in asset managers, for example.
Right.
Do you want to be more EM focused? Do you want global focus, or do you want true alternative exposure?
Sure, that's very insightful. And certainly you mentioned something with regards to Russia. I read, I think today or yesterday, that some Russian battleships and troop carriers were sailing past the UK on their way to the Ukraine. And obviously with the gas supply routes, you know, the routes coming through Eastern Europe to Western Europe, that's certainly something very, very well worth looking for. So thank you. Yes, that's really well pointed out there. I'm going to put you on the hot seat now, and I'm going to ask you, in terms of your sector, in terms of the stocks that you're forecasting, the 12-month price forecasts for 2022, what is your favorite? Do you have a favorite? Are you allowed to say your favorite? Which stock should we be looking at, given you're doing so well and we have ranked you so highly? We're really interested to hear what you have to say, and please share with us if you.
Yeah, of course. Probably, I'd like to highlight a stock which probably very few people on this call have heard of, but should definitely know about. It's a stock called Gresham House. The ticker is GHE. It's a 350 million market cap company listed on the UK AIM market. And it's one of our top picks in our small and mid cap financials coverage here in the UK. And essentially what it is, it's an alternative asset manager focusing on real assets with a specialism in ESG and sustainability, which we all know is a huge topic and a global investment megatrend, well established now. So Gresham focuses on forestry management, new energy, housing and infrastructure. Key reasons why we like it and why we think it will outperform this year. Firstly, as I've mentioned, ESG sustainability, a really, really strong theme. It has been over the last 12 to 24 months. And in terms of Gresham strategies, it's really, really well positioned to benefit from that structural tailwind of asset allocation towards ESG sustainability. Secondly, it's a true specialist. It's a high margin manager. It has strong market position. It's the UK's #1 forest manager. It has a 30% share in UK battery storage. So it really is a market leader. And thirdly, net flow momentum has been really strong. So it has been able to take advantage of those tailwinds that I spoke about so far, and would expect it to continue to do so. So we've been in an upgrade cycle with it. They have upped their assets under management target for 2025 once already. We wouldn't be surprised to see them do it again. And in terms of valuation, it looks really attractive. So we compare it to other European listed alternative asset managers, and it trades at a 50% EV to EBITDA discount on 1 year forward numbers.
Wow.
And
that's
I think
attractive.
It most certainly is. And I think some of that can be explained by its size, but also its the visibility around the stock, and it's growing its profile now. I'm here talking about it. So we'd fully expect to see that valuation gap correct as it continues to deliver over the next 12 to 24 months. So we can see sort of 50% plus upside on this one.
Beautiful. Thank you so much.
Now I see Randy's jumped back in. Randy, we can see and hear you.
Excellent. Yeah, sorry about that.
No, all good. Welcome back. Now that you're
technology is great when it works.
Exactly. It's always some bugs to work out, but you made it. So we're happy to have you here. And now that you're here, I'll put you right into the hot spot. Very similar question to Portia there. As we go into the next year, is there a stock or two that you're feeling exceptionally bullish on, or what are your top picks for the coming year?
Yeah, absolutely. Thanks again for having me. Really excited to be here. Shipping had a great year in 2021. We focus on the energy maritime sector. So any commodity that floats, be it LNG, LPG, crude oil, products tankers, dry bulk vessels, or container ships. So looking into 2022, our top, probably let's call it 3 picks, just to give a little diversification. Number 1 is ZIM Holdings. That's ticker ZIM. It was certainly the best performer last year. Clearly, container rates are surging. Port congestion remains high. Consumer spending is elevated. ZIM, for example, market cap of about $7.5 billion. EBITDA in 21 is about 6.5. 22 is going to be close to it, somewhere between $6 and $6.5 billion, right? So they're basically earning their market cap in a year in terms of EBITDA. So their enterprise valuation is even less than their market cap because they have negative net debt. They have more cash on the balance sheet than debt or long-term lease liabilities. So pretty remarkable story there. We're very bullish on ZIM. You're going to get a 10 to 15, that's right, $10 to $15 dividend in March. Current share price is like $62. And then thereafter, they're paying out 20% of net income. So we expect another $4 to $8 in dividends throughout 2022. So somewhere between $16 to $20 in dividends alone. Plus, the company is now kind of guiding towards share repurchases with all of the cash on the balance sheet. And the market continues to remain very robust. So top pick is ZIM. Second would be Golar LNG. So it's ticker GLNG. They transport LNG, they liquefy natural gas and turn it into LNG off the coast of West Africa. So that company has certainly a lot of catalysts, right? They have a new project coming with BP. They have the Hilli, their current FLNG project is expanding production. So that has the most growth upside. That's ticker GLNG. And then third and lastly, I'll give a dry bulk company, and that's Star Bulk Carriers, ticker SBLK. They're moving iron ore, coal, grains, any real dry commodities really around the world. They're paying out their entire cash flow in dividends. So we're expecting somewhere between $4 to $6 in dividends on a $22 stock. Again, very strong total return yield on that dividend play. So those are our top 3 picks in a very strong shipping environment, especially when you look at kind of the ongoing shift from momentum growth names to economically sensitive value stocks, right? And shipping really fits that bill.
Yeah. And I'm a big dividend fan, so those got my attention for sure. That's impressive.
Me too. I was scribbling down.
Yeah, right? Like, okay, good yield. We also have U.S. Treasury bond yields indicating Fed hikes for 2022. So how would you see this impacting the market and more specifically your sector?
Yeah, so that's a great question. I think it certainly is negative on these highly valued growth stocks. Right now, you're going to have to discount at a higher rate. Whereas it comes to value and shipping, it's probably arguably a good thing, especially when you look at high inflation rates. When you have a high inflationary environment, you want hard assets, steel, right? And these ships are made of a lot of steel. So in that environment, their financing costs might go up, 25 to 50, 75 basis points. But right now, the vast majority of their balance sheets are in great shape. We're talking 20, 25% leverage. As well as their hard assets. The ships themselves are going to start being worth more and more, right? With labor, with the commodity prices being what they are. So we think it's a great inflationary hedge, a great opportunity for a rising interest rate environment to get into these kind of high steel, high asset values shipping stocks.
Awesome. Thank you.
Great, thanks. John, over to you. Your turn for the hot seat. So firstly, when you go about making a 12-month price forecast for a particular stock, can you give us a brief overview of some of the factors that you really like to concentrate on that gives you the superior edge of your statistics that we went over earlier, please?
Thank you. And again, lovely to be with all of you, and I appreciate you holding this forum today. Let me begin by saying, energy, I've spent my entire life as an engineer, forward banker and a research analyst for over 20 years now in energy. So, 2021 was a bit of a unique inflection in terms of the energy cycle. And all you had to do is kind of be somewhere remotely close to energy, and you probably to some degree outperformed. So, a lot of the statistics you see as reflected in my statistics, for instance, is a function of the fact that the macro environment, the energy commodity macro environment was quite favorable. So backing up from that, the framework as an engineer by background, almost everything that I do in terms of analytical constructs is a mathematical exercise. I have a lot of dialogue with companies, but I basically reverse engineer to some large degree the underlying capital intensities businesses to try to understand the productivity of that capital. But the first thing we do is really very extensive, pretty intense macro work to try to get a sense of where these energy commodities are going. And what we saw coming out of this pandemic was simply a circumstance that likely suggested demand recovery as we exited this pandemic with some lagging supply response. And OPEC Plus was obviously a vehicle in that. And that's what you saw rematerialize in terms of economic commodity backdrop versus the 2020 experience. And these stocks are going to benefit from that. The R-squared correlation of energy or commodity linked securities is upwards of 80% plus or minus. So overwhelmingly, a lot of the influence on shareholder performance is going to be macro and fundamental related. In terms of the microeconomic analysis, I have been very blessed in life. I have had the opportunity to spend many years as an engineer with major oil and gas companies, Royal Dutch Shell and Atlantic Richfield, in banking at Solomon Brothers and Jefferies. And then I had the opportunity after engineering school to go to the University of Chicago for finance and economics. And that really, I just basically stomp on the shoulders of Benjamin Graham for all intents and purposes. I'm focused on full cycle economic outcomes, long dated models, terminated to perpetuity, using capital asset pricing theory very aggressively in terms of understanding underlying discount rates. All I'm trying to do is just try to analytically create as intense of an economic construct as humanly potentially feasible. There's profound limitations in what I do, but I just try to advance that. And then what I do is let the economic outcomes be whatever they are. We talked about in March of 2020 a generational opportunity in energy, and upgraded names in the context of the March 2020 experience. Not because I had any crystal ball, but felt like there was enough disequilibrium and the long dated reset would be such that would be the outcome. And we so we live by these ratings and we live by our economic outcomes. And so we try to stay very disciplined with that. And I think one thing that would be helpful to your audience is to create an economic structure that represents as best as you can understand and forward reality. None of us know what the future is to a large degree. What we're trying to do, though, is create a realistic framework. We talked about inflation forces today, the post-pandemic setting, and then create something that has economic coherence and then be disciplined to it. And that's for us providing advice. That's for the retail. That's for the institutional community, is be disciplined about that. I tell CEOs often, I think this might be helpful. And I know I've been around this now. I know pretty much everyone is, I will probably be your best friend in many instances when nobody likes you. And when everybody loves you, I'll probably be fading you. So, pretty contrarian, and investing kind of tends to be kind of in all sectors kind of a contrarian experience for people who are successful at it. The $64,000 question becomes, when do you get in and when do you get out?
Right.
The honest answer to that question is nobody knows. You got to pick tops and bottoms, and there's a crass statement that goes along with that I won't enter into this conversation, but stick to a coherent frame predicated on economic reality. Have a nice, vigorous dialogue with the people that your securities that you're studying, and then take no prisoners in the context of your views. Don't allow yourself to be moved in the context of people's wishes. Disneyland is lovely for Disneyland, but it's not the real world. So these are some of the precepts. This is the framework. And for me personally, I'm very blessed because, I need to make a living as a byproduct of doing this work. But really for me, this work is kind of a mission. It's kind of something. Energy has been a disaster for all intents and purposes. 2021 was wonderful, but energy structurally has been a disaster because basically it's been a overwhelming dollar recycle exercise, and that's now changing. And hopefully we've had a part, and I've had a part in full cycle economic outcomes, spending well inside cash generation, displaying observable economic returns rather than suggesting it in a PowerPoint presentation. And that's probably some of the evolution that's happening in energy, and that's a healthy evolution. Randy, back to you.
Great. Well, thank you. Clearly, an immense amount of work that goes into the backdrop of finding out and analyzing companies and putting those recommendations and analysis together. So credit to you for going through that process. In terms of risk, I want to address some risk reports. It's been very much on the SEC's horizon for companies now to put out quarterly risk reports, 10K, and annual risk reports, 10Qs, and put these into their reports on a quarterly basis. These are quite long and detailed reports. How much weighting do you put into these risk factors when looking at a 12-month price forecast, for example?
I take it you're posing a question to me, Randy?
Yes, John, please.
Sure. Okay. That's a kind of, first of all, there are some arguments around financial disclosure.
Right.
And about what I'm about to say may sound fairly radical, but one thing that's part of process is to literally scroll, through filing documents, every page, walk them to see, what, and you'll pick some things up out of that.
Right.
But when it comes to the risk factor section, that's something you almost inherently have to speed read through because of the density of it and the intensity of it. Our financial disclosure in this world has gone way overboard. The reality of the financial disclosure process is what we should do. We attempted to do this about 10 years ago. We need to start over, get very layman, and really lay in risks that, obviously if you invest in energy companies, you've got risk in terms of oil and gas markets. I'm not sure what the value add putting disclosure about the fact that you're investing in oil and gas and therefore oil and gas prices are a risk. I think we have to be more commonsensical to some degree about the way we look at financial disclosure. Let me say this though. I've worked over these years with the smartest guys, and I'm not talking about me because I got nothing to do with this. The smartest guys in engaging investments in energy at all the places. And the thing that is interesting about energy, given the underlying commodity volatility, the capitalization leverage, which is diminishing somewhat, these are radically high beta investments. And people do not appreciate the risk embrace in energy. The smartest guys in the room, they did not over the years appreciate the risk intensity of these investments. Yes, there's opportunity, but there's risk. These are highly leveraged ways and vehicles, and there's legitimacy to them to make bets essentially on the commodity. And so the appreciation of the sensitivity, we run an analysis we publish every week, which is a beta sensitivity analysis looking at that risk profile. And I'm told all the time, wow, just a dollar change is 4%, 5% delta in NPV. A nickel change in gas is 6-7% change in NPV. Seems like a lot, but it's mathematically legitimate. And so, you know, you have to be sensitive to those risks, and that we discount all of this accordingly. This is an industry that we beta profile in the neighborhood of 1.5, and it walks down a little bit in the Exxon Mobils of the world, and it walks up towards a beta profile of 2 for smaller cap names. I don't know exactly if I've addressed your question, honestly, Randy. You got me all excited. I went a whole nother way, but
Joe,
back to you.
Joe, not Randy. Randy's below you. If you can see on the square, I don't know if I'm on your screen beside you.
My
Randy's got a lot better hairdo than I have.
No, Randy's looking better than everybody.
He's also got better eyesight.
What is your name again? My apologies.
That's okay. I'm Joe.
Joe.
It's very easy. It's very easy to remember. It's actually very easy to remember. You just think of your average Joe, and I'm him.
Joe. My apologies, Joe. My apologies, Randy. I wasn't talking to just you on that one. It was talking to Joe.
I got a big upgrade there, being called Randy, but that's okay.
I'll just add to John's comment though there on this disclosure. It's a lot of catch-all, which is a catch-none almost in a way. Like there's just too much, and the risks that really are the pertinent risks to these stocks rarely are really highlighted in those risk sections anyways. And it's just it's a disclosure. It's something that it feels like the SEC is trying to do something, but it doesn't actually catch any of the real risks here that are involved in these names.
Interesting.
Yeah, makes sense. So we are going to jump over and take some viewer questions and everything as well. But just before we get into those questions, we have an excellent surprise for all of our analysts that have joined us here today. So to reward you for your diligent research and recommendations, we are going to be giving you guys each a TipRanks NFT. So these NFTs have been designed in-house by our wonderful team, and they'll give you guys special perks and benefits that'll be announced throughout the year as well, which will include access to different special events, early access to new features and products, highlights on specific analysts, and more. So they'll provide benefits to you. If you want to hold them, sell them, whatever, it's up to you, but these will grow in value over time and will be eligible for tons of different benefits, not just from TipRanks, but other industry leaders that we partner with as well. So as a thank you to you guys for being here and all your wonderful recommendations.
Great.
Thank
so
you.
Awesome. We're getting some questions here, hard and fast, from all of those thousands that are watching us stream live. Randy, I'm going to pick on you to start with. We got a question from Shane. And Shane is saying, when do you think that analysts are going to start covering cryptocurrencies? Crypto is very vogue. When are stock analysts going to switch to crypto? Do you think that's going to happen? And if so?
Yeah, that's a very good question. A lot of our research is very fundamental, right? We're looking at supply-demand fundamentals. And it's hard with cryptos. That's very momentum, right? And it's, well, which crypto do you go? Bitcoin, Ethereum, Dogecoin? I don't know. There's literally a million of them nowadays. So there are certainly at Jefferies, we have like a crypto kind of desk, right? But in terms of fundamental equity research or crypto research, I don't know. I'm sure when investor demand is there will be coverage. NFTs will probably be covered at some point, right? But in terms of the near term, I don't know of any plans, at least at our firm. Maybe some of the others can comment on that as well.
Great, thank you.
I'd love to hear Portia's take on this as well, since you are very much in the finance area there as well, on the cryptocurrency side, but also we have a question from Sky about the meme stock trend as well. So kind of a two-part question there, if you wouldn't mind weighing in.
Yeah, I think crypto is an area that certainly gaining increasing interest from an institutional perspective. Obviously seems to come and go in waves. There's much more enthusiasm when Bitcoin's rallying than not. So we see it here across our desk periodically. I think in the fullness of time, it will be something that analysts cover, and certainly as it becomes more institutionalized, I really don't think it's a trend that we can dismiss as going away now, with large institutions globally investing in it, with the Bank of England and other kind of monetary bodies investing research and entertaining the concepts of national cryptocurrencies. I think it's very much here to stay. I think on the meme stock side of things, obviously it was very much US focused, so yes. We had great fun observing it from here in the UK. But there were certain companies within our coverage universe which were ways to play that. So the CFD spread betting companies. So CFDs are not something that you guys have in the US, but here we have IG Group, CMC Markets, and Plus 500. All ways to play the stock market in a leveraged way. So they did very well on the back of the meme stock trend. And any time we see increased volatility in markets, those are kind of safe haven stocks that we would usually recommend to our clients.
Awesome. Thank you.
John, we have an inspired analyst. That's at least their login code. They're called the Inspired Analyst, and they have an in question. It's hopefully going to inspire you. You mentioned tech stocks and the potential of them not to perform against inflationary environment. One of you analysts said, I forgive if it wasn't you, John, but Inspired Analysts asks, how do you see tech stocks in 2022? What would you have a particular view?
Well, I would give you a view, but I'm not sure my view on tech stocks would be worth me giving you a view on. Honestly, I appreciate the question. I appreciate the inspiration. Yeah, Randy, I think you had some authorship on a little bit of a commentary on the tech sector. I'll say one thing, and if you'll permit me, Joe, I'll transition it over to Randy.
Sounds good.
I got Randy. I got the people correct here now. I've lived a life from a securities analysis perspective, and very tangible, capital intensive is what I'm trying to say, industries, and I see in that the kind of multiple turns on EBITDA that are probably legitimate, and also in instances I've seen where they're illegitimate, both in terms of compression and expansion. What does fascinate me to some degree, and again, there's a departure here between capital-intensive industries and industries that just don't have that really insane, almost very intense level of capital intensity, which energy does. I find it challenging at times to see business propositions that express 50, 70 turns on EBITDA, knowing that they are less capital intensive, the kind of economic outcome that would justify or require at times challenges someone. But see, you got to remember, my perspective is in a capital intensive world where I'm seeing numbers that are inside of 10 turns on EBITDA. I'll just say it simply that way, as being the extreme of kind of economic justification for a security clearing price. Randy, let me move it over to you.
Yeah, I'm kind of in John's boat. I'm a energy maritime analyst. We have tech analysts who are great at Jefferies, but so I will say this, right? When you look at the globe, and especially the US and Israel and Europe in 2022, do you expect more economic activity or less, right? Tech companies did great in 2020, 2021, when everyone was at home, ordering products, clicking likes on pictures, doing remote everything, right? Whereas hopefully this conference a year from now is in person. So when people are traveling and going outside again and economies are reopening, you would think the demand and maybe the valuation for some of these soft kind of tech companies that have crazy multiples, right? If it's 20 times or 200 times, who knows? those valuations will start to appear stretched when you have hard asset companies. Again, I'm plugging shipping here, that are trading at 2x multiples, right? So I'm with John in that kind of valuation perspective.
So we could be looking for the great rotation, or are we in the great rotation? That's one to ponder.
Joe, let me jump in here on something just for the benefit of your audience. A couple things. We had a very constructive relative to market in the energy sector. You're going to get that again in 22, very probably. We're maybe a little bit overly intense in the front end of the curve in terms of these oil and gas prices, but there's a 2 or 3 year recalibration process that's unfolding here. And we probably get about half the performance, which was almost 60% last year in the XOP index. We get that about a half again this year. So it's probable that you're going to see another year of relative market outperformance. Now, we've captured about 10% of that here right at the front of the year. But for your audience, there is a couple year process that's unfolding here in terms of the energy complex and its relative market performance. Back to you.
Great. Thank you. Thank you so much.
We have another question from Andrew asking about which sectors and stocks are worth focusing on given inflation. And Jeremy, I know we discussed this a bit earlier with energy and how it's related to inflation. Is there other sectors to keep an eye on, or what are some of your top stock picks in that area, since we didn't get into your most bullish ones before?
Yeah, I'll stick with inflation here. And I think as the world transitions to more renewable energy, and we really do see an energy crisis throughout the world, that all leads to inflation. I think that is part of the core reason why we're seeing more and more inflation, worldwide here. And as back to John's point, I think 2022 exactly is setting up to be another great year for energy. And so you're trying to decide, which names have run, which names still have a lot more to run. And being here in Canada, where we talk to almost every major oil and gas company, their number one problem is getting staff here to run rigs, to find employment, and you can't find anybody. So despite if they want to increase their spending on to go drill more wells, they just can't find the staff to do it. And part of the issue is that just being a sunset industry, you're just not attracting that type of people to the industry here anymore, and to want to have a 20-year time horizon. So it feels like inflation could be around for quite some time, because this energy crisis doesn't seem like it's abating anytime soon here.
The interesting thing about the whole concept of sunset, if you'll permit me real quickly, for humanity's sake and global CO2 imbalances, I mean, we wish that were the case. One thing that began really in early 19 and 24 is really trying to understand all forms of energy. And the reality is humanity needs massive degrees of nuclear fission additions in terms of no carbon forms of power, but the humanity's turned its back on that outside of China. What we're going to see over these next 2 decades it's going to challenge humanity to some degree, is we're going to see still a very long cycle progressive uptake in terms of global natural gas demand, and liquid hydrocarbons will plateau sometime early part of next decade, and then start to stabilize in an atrophy sometime around the second half of next decade. So there's a very long cycle in terms of multi-decades in front of an energy transition at some level. But the reality of all of that is that we don't really have the technical capabilities to wholesale make the kind of transition that's necessary, or the amount of capital that's required that's ordained in our climate agreements. And we need to be honest and realistic about that. And either we're going to have to apply carbon taxes and policy that gets at these things, or we're not being legitimate in terms of the $100 trillion price tag associated with the transition over the next 2 to 3 decades.
Sure.
Interesting. Yeah, great. I mean, I'm definitely hearing the sounds of buy energy and buy into companies like Gresham that's got the side of the environment, which is the long curve as well that you're talking about, and commodity related stocks that like the shipping sector as well. This is very, very interesting. Quick question.
It's also
Go
worth
ahead, Portia, please.
worth mentioning on Gresham that 60% of its AUM is forestry, and timber is well known for its as an asset class, having inflation hedged properties, and that the management fees on those mandates are inflation linked. So from that perspective as well as it being an ESG sustainability play, it screens as attractive.
So certainly real assets, that sounds very, very much like the direction that the conversation amongst these top performing analysts is going here. Portia, Ricky wants to know if you would be so kind as to tell him, what is your view of fintech, and what do you think of SoFi recently becoming a charter bank?
SoFi, Sorry, I thought you said something there. SoFi, I probably not close enough to comment on, but I guess fintech generally, every company in our coverage universe, whether it's got anything to do with tech or not, wants to be a fintech, because the perception is fintechs attract high multiples. So it is it's up to us to be very kind of discerning and, I guess, analytical in that regard. What screens as a genuine fintech and what doesn't. I guess the kind of key characteristics of fintechs are low capital intensity, high ROE businesses, and that's genuinely what we'd expect to see. I think one genuine fintech business within our coverage universe is Aquis Exchange, which is Europe's fastest growing stock exchange. It is a disruptor and competitor to the London Stock Exchange and specifically the AIM market. And its sort of three businesses are market making and trading platform, listing exchange, and being a technology provider. It's making very strong inroads, delivers a very high ROE, which is expanding, and we genuinely point it out as a fintech disruptor within our coverage universe, which many claim to be, but can't really substantiate besides having gone virtual with meetings, which translates to Zoom. That's genuinely fintech claim.
No, that's great. Jeremy, do you have an opinion on this question?
Sorry, just what was can you repeat the question again? I'm just looking at this other question here.
Yeah, I think we have another question for Jeremy here from Ronnie, if we can lob that over to him. And this is an interesting one as well. I'm very curious about the answer. And that is, why do analysts hardly ever give sell ratings? We have a very heavy lean towards the buy ratings. So where are the sell ratings?
Yeah, and that's naturally across the whole sector here. And maybe for my sector here for energy, this is a very close-knit community here in Calgary. But that doesn't mean you get a buy rating kind of thing. There's still, if you have a bad company, your full cycle economics, don't make money, you get a sell rating here. But part of the issue is where, we, as analysts, provide value is information. And that's almost more important than sometimes ratings here. What's the insight with the company? What's going on with something new? And part of that is you have to really have a good balance between getting good information and good not. So I'll give you an example here. So one of our top picks here in Canada is a company called Tourmaline. They're a $12 billion company, produce one of the biggest gas companies here in Canada. Their operations are in Northeast BC, where the valuation has been quite hit hard because there is an Indigenous situation that pretty much stops any new well licenses going on in Canada. An election was just held with that Indigenous group, where the new chief actually happens to own an oil field service company through her husband. And it's just little insight information like that makes you think, wait a sec, there could be a change of the tone at the top here that maybe gets negotiations back around. So given the valuation hit with these companies, with this change in the top, it could get new investors back. So it's reasons like that where sometimes if you potentially, like, you can still say the same thing with a hold versus a sell, but it's just to get that information is equally as valuable to investors to know some of the context here.
Sure. Yeah.
Okay, we have a question from Avi, and I'm going to put this to all of you to choose who answers this question. But is there an innovation or a technological innovation that excites you?
Can I? That's everything. What you just said, Joe, is everything. It is incredible the cycle times of the analysis that you can now do leveraging technology. I don't mean to do it, but I'll plug Bloomberg here. I mean, a massive amount of macro data I can integrate into analysis with an update button. Computing technology is speeding up, and it really is cool. The massive amount, the velocity of being able to execute analysis based on largely the evolution in technology. And obviously having multi-screens, being able to lay different things up in parallel. What I'm looking for, and there's some of this developing, is that financial disclosures, and I can do this, but you run into issues sometimes in connectivity where I bring up a financial disclosure and it immediately populates a piece of economic analysis. There's limits to how much of that you can really do because you want to look at some of the data that's flowing in yourself, and that is by entering it. But there's no way in the world I could remotely try to execute the scope of macro and microeconomics that I'm attempting. And I'll just say this, it's an attempt without the leverage of technology and the evolution of technology. And it's data feed-ins. And the other thing that's happening, which is really important, and I work with the companies on this, is the disclosure's gotten, in the context of the things that matter, the disclosure's gotten cleaner. It's evolved, it's improved. And that's helpful, again, in speeding the cycle time of integrating and updating analysis.
Great. Thank you.
Anybody else want to jump in on that? Yeah.
Sure. I'll chime in a little bit on shipping technology. I think on one side of the equation, you have a company like Zim that has multiple kind of digital offerings, some technological advances that really helps in their efficiencies, loading, tracking, containers, what port to go to. Obviously, it's all congested in LA Long Beach. So can we go over to Houston or Savannah or, Oakland or Seattle and I'll get offloaded quicker. So there's a lot of digitalization and efficiency that is happening through technology. And then the other part of technology that we hear a lot in terms of shipping is the technological advancements in propulsion. Historically, it's just been bunker fuel oil, highly pollutant, a lot of carbon intensity there. So now the big switch is that technological advancement in terms of, do you go LNG powered ships, ammonia, hydrogen, nitrogen, right? What is 5-10 years from now? What does it look like in terms of the propulsion capabilities of the ships? It probably won't be the current bunker fuel that we're using now. So what will it be in 5 years and in 25 years? So that kind of technological advancement will certainly drive the shipping sector.
Great. Okay, so I think we're running tight on time here now. So I think this might just well be the last question. Yana asks, what advice do you have for new investors just starting out? Jeremy, maybe you could give Yana a piece of wisdom on new investors.
You know what? I would understand what most investors do in terms of looking at the standard metrics and understand why you shouldn't use those. Find another unique reason why there's holes in those standard ways that people look at things. You got to be a contrarian to the way the market is going, and the understand those aren't typically, if you're looking for something that has growth, that growth is already priced into the market here. You got to find something else, nuances to why that stock will continue to perform.
Great. And use TipRanks.
There you go. Awesome. Well, we'll wrap this up, guys. I just want to say a massive thank you to all of our analysts here, Jeremy, John, Randy, Portia. It has been really fascinating listening to you guys. I know I learned a bunch, and I'm sure all the viewers did too. So thank you so much for taking time out of your busy schedules to hang out with us today for our first annual TipRanks Top Analyst live event. We'll hopefully see you back here next year, eventually as the world reopens. Hopefully we can do this in person someday, but thank you guys again so much. Thanks to everybody watching, and we'll sign off from there. Have a great day, guys.
Congratulations on being TipRanks finest.
Thank you all very much. It was an honor.